16 days. That is all the time left before the math becomes impossible to hide, before the paper promises meet physical reality, before 82 million ounces have to somehow satisfy demands for 425 million. I've been watching the COMEX warehouse reports every single day for the past month, refreshing the data, tracking every withdrawal, every deposit, every change. And what I am seeing is not a market correction. It is not profit-taking. It is not normal volatility. It is a systematic drainage of physical silver from the vaults at a pace that has never happened in the history of commodity exchanges. 785,000 ounces leaving every day, every single day, week after week, month after month. And in 16 days, on February 27th, March delivery intentions get declared. And the numbers do not work. They cannot work. The math is broken. And when I show you exactly how broken it is, when you see how many ounces are claimed versus how many actually exist in the vaults, when you understand what happened in January and February that changed everything, you will understand why some of the most respected analysts in commodities are calling March 2026 the funeral of COMEX. Let me show you what is happening right now, right this moment. It is February 11th, 2026. Silver is trading around $82 per ounce, up from around $30 just 12 months ago, nearly triple in 1 year. But that is not the story. The story is what is happening in the vaults. COMEX registered inventory, the metal that is actually available for delivery against futures contracts, stands at 82 million ounces, down from 167 million in October, a 50% collapse in just 4 months, half the inventory gone. But March 2026 open interest represents 425 million ounces of claims. Read that number again. 425 million ounces of claims against the system, 82 million ounces of actual metal. That is a 5-to-1 ratio. 5 people think they own the same ounce. 5 contracts written against 1 bar of silver. And in a normal futures market, that would be fine, perfectly normal, because historically only 10% to 20% of contracts stand for delivery. Everyone else rolls forward to the next month, closes for cash settlement, extends their position without taking metal. The system works because the system assumes nobody actually wants the physical silver. They just want exposure to the price, but February just proved that assumption is dead. Out of 19 million ounces of open interest in February contracts, 18.7 million ounces stood for delivery. That is 98%, not 10%, not 20%, not even 50%. 98% of contracts demanded physical metal. Read that again and understand what it means. This is not a futures market anymore. This is not price speculation. This is not hedging. This is a bank run, a slow motion run on the vault, everyone demanding their metal at the same time. And January was even worse. 49 million ounces delivered in a month that typically sees 6 to 7 million. A month that is not even supposed to be an active delivery month. January is historically a rollover period, a quiet month between December and March. But January 2026 delivered 7 times the normal amount. 7 times. And the pattern is clear. People are not waiting for March. They are pulling delivery forward. They are rolling backward instead of forward. They are paying premiums to get earlier delivery months, accepting January contracts that are already expiring, accepting February contracts at higher prices, demanding metal now instead of later, because they know something. And what they know is this: the vaults are emptying faster than they can be refilled. Every week since October, inventory has dropped. No breaks, no pauses, no refills. Just 785,000 ounces per day leaving the system. If that drainage rate continues for 16 more days until February 27th, first notice day, COMEX will have around 70 million ounces left. Maybe 65 million if the rate accelerates like it did in early January when 33 million ounces vanished in 7 days. But here's the problem, the math problem that has no solution. If only 25% of March contracts stand for delivery, which is actually conservative based on what we just witnessed in January and February, COMEX needs 106 million ounces, more than they will have in the vaults, more than exists in registered inventory. If March matches February intensity at that 98% delivery rate, we are looking at demands for 416 million ounces. Against available supply of 70 million or less, the math does not work. It is mathematically impossible. There is no scenario where this adds up. And on February 27th, first notice day for March contracts, the world finds out what happens when paper promises cannot be backed by physical metal. When the fractional reserve system that has operated for decades faces a stress test it was never designed to handle. Now let me show you why this time is different from every other silver squeeze attempt in history. In 1980, when the Hunt brothers tried to corner the silver market and drove prices from $6 to $50, CME stepped in and created Silver Rule 7 out of thin air, changed the rules in the middle of the game, banned leveraged buying overnight, raised margins to impossible levels, crushed the rally, Silver dropped 80% from $50 to $10. Thousands of investors wiped out. The Hunt brothers bankrupted. In 2011, when retail investors discovered silver and tried the first silver squeeze, when prices ran from $8 to $50 in just months, CME raised margins 5 times in 9 days. 5 times. 84% increase in margin requirements. Made it too expensive to hold positions. Silver crashed 50%, from $50 to $26. Took 13 years to recover. 13 years for the price to get back to $50. Both times, the system survived by changing the rules and scaring away the buyers. Both times, retail gave up and went home. Both times, the vaults refilled and life went on. But this time is fundamentally different, because this time, it is not retail. It is not speculators. It is not the Hunt brothers trying to corner the market. It is industrial buyers, solar panel manufacturers who need 300 million ounces per year and cannot substitute another metal. Electric vehicle production lines that require silver for battery systems and electronics. Electronics fabrication plants that need silver for circuit boards and semiconductors with no commercial alternative. AI data center build-outs that need silver for every server rack and cooling system. Medical equipment manufacturers. 5G infrastructure. Defense contractors building missile guidance systems. These are not speculators who panic when margins double. These are manufacturers who will pay premiums of 50%, 70%, even 100%, rather than halt production lines that cost millions per day to operate. And they are doing something the futures market was not designed for. They are taking delivery, physical metal, moving it out of COMEX vaults, putting it on trucks, shipping it to their own warehouses, their own storage facilities, their own control, removing it from the available pool permanently. And here's the proof it is accelerating. Between early January and mid-January, in just 7 trading days, 33 million ounces were withdrawn from COMEX for delivery. That is 26% of registered inventory gone in 1 week. 1 week. Over a quarter of the available supply vanished in 5 business days. On some days, 3 million ounces left with 0 ounces deposited. 0 coming in, only metal going out, only withdrawals, only deliveries, no new supply entering the system. The metal is leaving, and it is not coming back. Because once you take physical delivery and move silver out of a COMEX-approved warehouse, it is no longer registered inventory. It is no longer part of the pool available for future deliveries. It is no longer in the system. It is gone, permanently removed. And every single ounce that leaves makes the math worse for everyone still holding short positions. Every ounce that gets delivered tightens the noose on the banks. Now let me tell you who is trapped. Because the banks know this. They have access to the real-time warehouse data. They see the withdrawals. They see the delivery rates. They have run the numbers on March. They know March is a bloodbath waiting to happen. But they cannot cover their short positions without triggering the exact scenario they are trying to avoid. Because if JP Morgan or any other major bank starts buying 50 million ounces in the open market to close their shorts, every algorithm on Wall Street detects the buying pattern within milliseconds. High-frequency trading systems identify the pattern, front-run the orders. Momentum funds see the move and pile in. Retail investors see silver spiking and add fuel with FOMO buying. And the price explodes to $120, $150, maybe $200 before the banks finish covering their positions. They lose billions. Their quarterly earnings get destroyed. Their reputation takes permanent damage. They are trapped between 2 terrible choices: default on delivery obligations and face legal consequences and reputational destruction, or cover at any price and trigger a short squeeze that costs them billions and exposes the fractional reserve game publicly. And the data suggests they might already be panicking. Look at what happened in January with the inventory numbers. Total inventory dropped 64 million ounces from December levels to February. But reported deliveries in January were only 49 million ounces. Where did the other 15 million ounces go? They left COMEX entirely, moved to London, shipped to Shanghai, transferred to private vaults in Switzerland and Singapore. The metal disappeared from the system without being counted in official delivery statistics. It just vanished, moved to other jurisdictions, other storage facilities, other ownership structures outside COMEX control. And now China has made the global supply situation even worse. On January 1st, 2026, China officially reclassified silver as a strategic material, put it in the same export control category as rare earth elements, implemented licensing requirements, restricted exports. Only 44 companies received approved export licenses, down from over 100 previously. China is hoarding silver domestically, keeping the metal inside their borders, prioritizing their own solar panel build-out, their own electric vehicle production, their own electronics manufacturing, their own strategic reserves. The second largest refiner of silver in the world just cut off global supply. And COMEX cannot replace that metal, cannot import from China anymore, cannot refill the vaults with Asian supply. The global supply chain just lost a major source, and the timing could not be worse. The math is getting worse every single day. But here is what kept me awake last night. The backwardation, the lease rates, the premium explosion, 3 technical signals that all point to the same conclusion. Extreme shortage. In normal commodity markets, futures contracts trade higher than spot prices because holding physical metal has costs. You need storage, you need insurance, you need financing. So March futures should trade at a premium to spot, should trade higher than the cash price. That is how it has worked for over a century. But in January, silver went into backwardation. Spot prices traded higher than futures. The cash price exceeded the March contract price. That only happens when physical demand is so urgent, so desperate, that buyers will pay more to get metal today than to get metal in 3 months. It is a technical signal of severe physical shortage, of panic buying at the spot level, of a market that knows available supply is disappearing faster than it can be replaced. And the lease rates confirm the shortage. In October, silver lease rates spiked to 34% annualized. Some intraday peaks hit 39%. Think about what that means. That is the cost to borrow physical silver for short-term delivery. The interest rate someone will pay to rent silver for a few days or weeks. When lease rates spike to 34% or 39%, it means someone desperately needs metal for immediate settlement and cannot find available supply at reasonable prices. They are bidding up the cost of borrowing because outright buying is impossible. There's no inventory for sale, no available ounces. They have to rent metal at usurious rates because purchasing is not an option. The physical market is screaming shortage at the top of its lungs, while the paper futures price trades like everything is normal and fine and under control. The disconnect is massive, the gap is growing, and it is about to break wide open. Let me show you what coin dealers and mints are seeing right now. COMEX says silver is $82 per ounce. That is the futures price, the benchmark, the number that appears on financial news tickers. But walk into any coin shop in America right now, try to buy physical silver. Silver Eagles are selling for $120 to $150. Generic rounds are $110 to $130. Bars are $100 to $120 depending on size and brand. That is a $30 to $68 premium over the COMEX spot price. In some cases, premiums are hitting 80% or more. Buyers are paying 80% more than the futures price just to get actual physical metal in their hands. If there was real available silver at $82, why would anyone pay $140? Why would premiums be at all-time record highs? Why would mints be shutting down sales, saying they cannot secure metal from refiners? Golden State Mint, one of the largest private mints in the country, stopped taking silver orders over a weekend because they could not source metal from their suppliers. That has only happened twice in modern history. March 2020, during the pandemic lockdowns, when the entire supply chain froze. And now, February 2026. The paper price says $82 and everything is fine. The physical market says there is no metal available at any reasonable price because the paper price is not real. The futures market is a confidence game, a fractional reserve system that only works as long as nobody demands the actual metal, as long as everyone agrees to settle in cash, as long as contracts get rolled forward instead of delivered. But once delivery rates hit 98%, once industrial buyers refuse to roll forward and demand physical settlement, once the vaults start emptying at 785,000 ounces per day, the confidence game ends. The fractional reserve breaks. The system collapses under its own leverage. And February 27th is the day the game ends. First notice day. That is when holders of March long positions must declare their intention. Take delivery or roll forward to May. Based on January delivery rates, based on February hitting 98%, based on the backwardation, based on the lease rate spikes, based on the premium explosion in physical markets, I expect somewhere between 100 and 200 million ounces to stand for delivery. COMEX will have 70 to 80 million ounces available in registered vaults. They will be short 20 to 130 million ounces, depending on actual demand. At that point, they face 3 options, 3 scenarios, none of them good. Option 1, deliver everything they have in the vaults and declare force majeure on the shortfall, cash settlement on remaining contracts. Public admission that physical delivery cannot be guaranteed, that the exchange cannot fulfill its obligations. Market confidence in COMEX as a price discovery mechanism collapses overnight. Every institution using COMEX for hedging, every manufacturer relying on COMEX for price risk management, immediately evaluates alternatives. Shanghai Futures Exchange, London Metal Exchange, over-the-counter private deals directly with miners. COMEX loses its monopoly on price discovery. The benchmark becomes irrelevant. Trading volumes collapse. Liquidity dries up. The exchange that has set global silver prices for decades becomes a side market. Option 2, invoke emergency powers before first notice day even arrives. Change the rules like they did in 1980. Ban physical deliveries temporarily or permanently. force cash settlement on all March contracts, regardless of contract holder preference, double or triple margin requirements overnight, halt trading if necessary, protect the banks and the clearing system at all costs. This keeps COMEX operational in the short term, but destroys long-term trust in commodity futures as a reliable hedging tool. Who will use an exchange that can unilaterally cancel delivery obligations when it becomes inconvenient? Who will trust contracts that can be voided by emergency decree? Option 3, let it run. Do nothing. Allow delivery intentions to be declared naturally. Allow the short squeeze to develop. Allow banks to scramble for metal. Allow the price to spike to whatever level is necessary to balance supply and demand. Silver goes to $120, $150, $200, maybe higher as banks desperately source metal to cover shorts. Massive losses on short positions. Billions in damage. Quarterly earnings destroyed. Reputations permanently damaged. But the system survives with credibility intact. Price discovery remains functional. Contracts are honored. Delivery obligations are met. The market continues to believe in the mechanism. Trust is maintained. The exchange lives to trade another day. But egos are shattered. Balance sheets bleed. Heads roll, executives get fired, congressional hearings get called, regulators launch investigations. None of those options are good. Every single scenario breaks something fundamental about how commodity markets have operated for over a century. But based on history, based on what happened in 1980 with Silver Rule 7, based on what happened in 2011 with 5 margin hikes in 9 days, the most likely outcome is option 2. They will protect the banks. They will invoke emergency powers. They will change the rules. They will force cash settlement, because they always have. Because that is what they do when the system faces existential stress. Protect the institutions at the expense of contract holders. But here's what makes 2026 different from 1980 and 2011. The buyers are different. In 1980, retail investors gave up after Silver Rule 7 and went home, sold their positions, took their losses, moved on to other investments. In 2011, retail speculators sold after 5 brutal margin hikes and swore off silver forever. The price took 13 years to recover because trust was destroyed and demand collapsed. But in 2026, the buyers are not retail speculators who can be scared away with rule changes. They are industrial manufacturers who need the metal to operate multi-billion-dollar production facilities. Solar companies cannot build panels without silver, and there is no substitute for the photovoltaic cells. Electric vehicle makers cannot manufacture battery management systems and electronics without silver. Semiconductor fabrication plants cannot produce chips without silver. Medical equipment. Manufacturers cannot build X-ray machines and diagnostic tools without silver. 5G infrastructure build-out requires silver for every antenna and relay system. Defense contractors need silver for missile guidance systems and radar. These manufacturers cannot stop buying because their entire business depends on continuous supply. And if COMEX invokes emergency powers and forces cash settlement, those manufacturers will not come back to COMEX. They will go to Shanghai. They will go to London. They will negotiate private deals directly with miners. They will establish over-the-counter markets. They will secure supply through bilateral contracts. They will build their own strategic reserves, anywhere they can get guaranteed physical delivery. And COMEX loses its monopoly on price discovery. The benchmark that the entire world has used for decades becomes meaningless. And when the benchmark dies, the paper market loses its reason to exist. Only physical matters. And physical is already trading at $120 to $150, while paper says 82. That $40 to $68 gap is not noise. It is not a temporary dislocation. It is the market screaming that the system is under existential stress, that paper promises and physical reality have begun to separate, that confidence is eroding in real time, that the fractional reserve game is ending. Now let me tell you what happens after March. Because even if COMEX somehow survives March by invoking option 2, by forcing cash settlement and emergency rule changes, the structural problem does not disappear. It gets worse. May 2026 contracts are building, open interest rising, July is stacking, September is loading. Every single month faces the same tightening math. Registered inventory still dropping, delivery rates still elevated, industrial demand not slowing. The crisis just rolls forward into the next month. And every time COMEX invokes emergency powers, every time they force cash settlement, every time they change the rules to protect banks, confidence erodes further. More manufacturers leave for physical markets. More metal flows out of registered vaults permanently. More buyers refuse to trust paper contracts. The death spiral accelerates. Because once you break trust by changing rules, you cannot rebuild trust by changing rules again. Each intervention makes the next crisis more likely and more severe. The system eats itself. This is not like 2011 when retail gave up and went home and silver stabilized and the market forgot about the squeeze. This is structural. This is industrial. This is strategic. China declared silver a strategic resource like rare earths. The US government added silver to the official critical minerals list. Governments around the world are treating silver like lithium, like cobalt, like materials, essential for national security and technological dominance and economic competitiveness. That is not speculative demand that disappears when prices fall or when Reddit loses interest. That is permanent structural demand that persists regardless of price, that continues regardless of market conditions, that cannot be scared away with margin hikes or rule changes. And COMEX registered inventory is sitting at 82 million ounces, trying to satisfy 425 million ounces of paper claims in a single contract month. 16 days from now, February 27th, first notice day, the math becomes impossible to hide. The leverage gets exposed, the fractional reserve breaks, and when the math breaks, when paper promises cannot be backed by physical metal, everything breaks. The pricing mechanism breaks, the hedging function breaks, the confidence breaks, the system breaks. Now I am not telling you what to do with this information. I am not making recommendations. I'm not giving advice. I am showing you the numbers. Public data that anyone with internet access can verify. CME warehouse reports updated daily. 425 million ounces of open interest in March 2026 silver futures. 82 million ounces of registered inventory as of February 11th. 98% delivery rate in February contracts. 49 million ounces delivered in January, 7 times historical average. 785,000 ounces draining daily since October, 16 days until first notice day. Those are facts, documented, published, verifiable. The question is, what happens when 5 people show up to claim the same ounce? When paper promises meet physical reality in real time with the whole world watching? When the fractional reserve system that has worked for decades suddenly faces a stress test it was never designed to handle? In 1980 and 2011, they changed the rules and saved the system because the buyers could be scared away. But this time, the buyers are manufacturers who cannot stop. This time, the demand is structural and permanent and strategic. This time, the math might force a reckoning that exposes how the system actually works. 16 days, that is all the time left. And on February 27th, we find out if COMEX survives or if March 2026 becomes the month the paper silver market died and only physical mattered anymore.